Okay, good morning. Welcome to our today's class. We are going to start on our first topic today, where we're going to be discussing on Introduction to Finance and Investment. That is our unit today, Introduction to Finance and Investment. Introduction to Finance and Investment. Can you hear me? Can you hear me? Yeah, good morning. We are going to discuss on Introduction to Finance and Investment. Introduction to Finance and Investment. This is a broad unit that has some part of theory that is covered by half theory and also half calculations. But we are going to mainly focus on calculations because they are broader, and to avoid being cut out of time, we are going to first discuss the calculation parts. We are going to start with calculation, but for today we are going to do an introduction. I'm going to introduce this unit, Introduction to Finance and Investment. Melvin Areso, I'll be taking you through this unit during this term. First of all, this unit of Introduction to Finance and Investment, it's basically a CIFA unit, yes? And it's in the introduction stage, the foundation level of CIFA, Introduction to Finance and Investment. We are going to first introduce this topic during this first session. We're just going to introduce the topic. We are going to know what we need to understand by the end of this term, what you expect during your exams, where you're supposed to mainly focus. This unit has both theory and calculation, as I said, but most of its questions are at the calculation level. So today I'm going to introduce, this unit has 10 chapters. It has 10 chapters. And among the 10 chapters, 5 of the chapters handle the theory part, while the other 5 discusses the calculation part. So our first topic under this unit, Introduction to Finance, you're supposed to be able to understand the nature and the purpose of finance. You understand the nature, that will be our chapter 1. You understand the nature and purpose of finance. Once you've done that, you'll go to your second chapter that handles the financial markets and systems, financial markets and systems. Then you'll go to your third chapter that handles the investment environment. Investment environment. Then our chapter 4 handles the financing decisions. So these ones are our first 4 chapters, and these first 4 chapters are on theory. Okay, you can't see the board. Are you able to see right now? You're telling me to adjust my camera. Can you see? Okay, it's fine. So on Introduction to Finance and Investment, I've told you we have 10 chapters that you are not supposed to understand by the end of this session. And our first 4 chapters, you have nature and purpose of finance, financial markets and systems, investment environment, the financing decisions. These are the first 4 chapters, and this one covers the theory part. Then from here, we will start discussing on the other chapters. Our 5th chapter handles the valuation of assets. Valuation of assets. Yes. So we have nature and purpose of finance, financial markets and systems, investment environment, the financing decisions, valuation of assets. Then we have cost of capital. As our 6th topic, cost of capital. Then from there, we have time value of money, time value of money. Then we'll also have introduction to risk and return. Introduction to risk and return. Introduction to risk and return. Then we have capital budgeting as our 9th chapter, capital budgeting. So these 5 chapters, valuation of assets, costs of capital, time value of money, introduction to risk and return, and capital budgeting. This part handles the calculation part. Then finally, we have our 10th chapter. Our 10th chapter handles the introduction to Islamic finance. Introduction to Islamic finance. So first of all, I'm going to measure my discussion on this calculation part, just in case time cuts us off, because this is the main part. Most of our papers come in calculations. So you're supposed to mainly focus on this calculation part: valuation of assets, cost of capital, time value of money, introduction to risk and return, capital budgeting, and capital budgeting, these 5 chapters. But similarly, you also have to understand 1 or 2 things on the nature and purpose of finance, financial markets and systems, investment environment, the financing decisions and introduction to Islamic finance. So for today, we are going to give an introduction on our first chapter. Today, we are going to discuss our first chapter, that is nature and purpose of finance. But from our next class, we are going to start discussing on the calculation part. We will start on valuation of assets during our next class. But today we are first going to discuss on the nature and purpose of finance for us to introduce the unit. Then coming the next class, we will start on valuation of assets. We will handle the calculation part first. Then if time allows us, we will review the theoretical part. I hope that is fine. So today, let's start on nature and purpose of finance. We'll start on nature and purpose of finance. Under nature and purpose of finance, first, what you're supposed to understand is the nature and scope. Nature and scope of finance. Under nature, purpose, and finance as our first chapter in Introduction to Finance and Investment. You'll first understand the nature and scope of finance. Once you understand this, you'll have to look at the financial decision-making process. Financial decision-making process. After that, you look at the relationship between finance and accounting. You look at the relationship that exists between finance and accounting. Once you look at that, you'll proceed to the goals of the firm. The goals of a firm. Then you'll finally look at the roles of a finance manager. The roles of finance managers. Once you look at that, you'll also proceed to, you'll also look at the agency theory or the agency relationship between various, that's the relationship that, the relationship that is there, the agency relationship. It's known as it's not the agency. Yeah, we can call it the agency relationship. Yes. Agency relationship. This is also known as the principal agent relationship. Principal agent relationship. Principal agent relationship. So let's first look at the nature and scope of finance. Nature and scope of finance. So let's first look at the nature and scope of finance. Our first subtopic on nature and purpose of finance, we look at the nature and scope of finance. Yes. When we are first told to look at the nature of finance, let's handle the nature of finance, then we look at the scope of finance. Now let's start with the nature of finance. The first aspect of nature of finance, you can look at resource allocation. Resource allocation. What do you mean by this? Resource allocation. This is the first nature of finance. Here it's a situation where the investors or the finance managers will evaluate the various activities within an organization and be able to allocate the resources based on the importance of an activity. Here we are supposed to first give a priority to the most important activities within the organization. Resource allocation. You allocate the resources based on the importance of an activity to a firm, or how best an activity is going to yield or give a return to the firm. Resource allocation. You choose the most viable activity within an organization and allocate the finances based on their importance. Resource allocation. That is the first nature of finance. The second nature of finance, we can look at time, value of money. Time, value of money. What you can understand by time value of money is that finance managers, for instance, they understand that money loses value as time goes by. This simply means that the value of a currency today or the value of a shilling today will be totally different to the value of the same shilling, let's say, come tomorrow. So investors or the finance managers, they believe that money loses value over time. As time goes, the value of a currency reduces. And that's what we mean by time value of money. Our third aspect or nature of finance, we can look at risk and return. Risk and return. as another nature of finance. Here, the finance managers will evaluate the riskiness of an investment, yes, and the value that can be generated once they decide to take the risk and invest in the investment. When they decide to allocate their resources to a certain activity, what are the chances that this activity will give back a reward to the organization? And that's what we mean by risk and return. If they risk their resources, if they decide, let's take this risk, risk is the uncertainty of an act. So when they decide to take a risk on a certain activity, what are the chances that this risk that they are taking is going to give them a return in future? Risk and return. So this is what when you're told to discuss the nature of finance, you can measure on these three aspects. So we have resource allocation, where you choose the most viable or the most important ideas within an organization, the ideas that are most that are much valuable to the firm, that will bring out the most reward or the most profit to the organization, and decide maybe to give it the most resources, because you believe that the resource or the activities are important and they're going to give a reward within back to the organization. Resource allocation. The other aspect is time value, where we said money. Okay, finance managers believe that money loses value over time. And in that case, time value of money is another nature of finance. They know that the value of a currency or a dollar today will be totally different to the value of the same dollar tomorrow. Time value of money. Our third nature of finance, we have risk and return. Risk and return, the uncertainty of an act, the value that will be generated from investing your funds or your resources in a certain activity. What are the chances that the risk will give you a certain or a beneficial aspect, the return? So that's what we have on nature of finance. Are we together? Any question? Yes, we're together. So we've done the nature of finance. Now let's look at the scope of finance. Scope of finance. The scope of finance. The first aspect on scope of finance, we can look at corporate finance. Corporate finance. This is one aspect on the scope of finance. Here we can see that finance as a concept focuses on financial decisions within a company. Finance as a concept, we have corporate finance, and under this you can say finance as a concept, it focuses on the financial decisions that are made within a company. The financial decision made within a company. Financial decisions made within a company. That is the first scope of finance, corporate finance. Second scope of finance, we can look at investments. This is another aspect on the scope of finance. Here we can say allocation of capital into various financial assets. Investment. This is a situation where finance managers allocate funds into various financial assets of the company with the goal of achieving an optimal return. The finance managers or the finance parties, they decide to invest, yes, or to allocate their resources into various financial assets that are within the company. And these financial assets can be in form of the stocks, the bonds, or the real estates that will affect the firm, that will bring a reward to the firm. Investments, it's another scope of finance. Here, the finance parties decide to allocate resources into various financial assets within the organization with the aim that they're going to achieve, yes, a positive or an optimal profit or a reward from their investment. So investment is another aspect on scope of finance. Our third aspect, we can talk of financial institutions. Financial institutions. Financial institutions, these are the finance intermediaries. The financial intermediaries that affect financial decisions. The financial intermediaries. This can include, maybe we can talk of the banks. Yes, for instance, banks are a bank is an example of a financial institution. We can also talk of insurance companies or even the investment firms. These are the financial institutions, the finance intermediaries that affect financial decisions of a firm, financial institution. We can also look at personal finances. Personal finance. These are financial decisions that are made on a personal level. Yeah, there are financial decisions made at a personal level, personal finance. They are made on a personal level, maybe how an individual can manage their personal assets, yes, how they can improve their nature of saving, how they can budget for their resources, be it minimal or limited, how they are going to budget for their resources to ensure that they cover all their needs. Personal finance. Individual, this is the financial decisions made at an individual level, a personal level. And they may include maybe the aspect of budgeting for your available resources, or how the nature of your saving, maybe for your retirement. Yes, those are personal financial decisions. And that is the other aspect of scope of finance. We have personal finance. We can also look at international finance. International finance. These are financial decisions made on a global scope. The financial decisions that are made on a global scope. International. Yes, they are made on a global scope. I guess that's what we can look at on the scope and nature of finance. So the first subtopic under nature and purpose of finance, you're supposed to understand nature and scope of finance. And I guess you've already handled that part, where we've said on nature, we can look at resource allocation, time value of money, and risk and return. Those are the nature and the scope of, the nature of finance. On scope, we've looked at the corporate finance, which are the financial decisions that are made within an organization, within a company, financial decisions made within a company. We've looked at the investment, financial institutions. These are the financial intermediaries. Personal finances. These are the financial decisions that are made on an individual level. Then we have international finance that focuses on finance decisions on a global scale or a global scope. International finance. Any question after that? Any question? There's no question. We can proceed. Our second subtopic, we are to understand the financial decision-making process. Financial decision-making process. Financial decision-making process. So we've already looked at nature and scope of finance. Now let's look at financial decision-making process. Financial decision-making process. First of all, what you are supposed to understand that correct? Okay, for when an organization makes correct financial decisions, it will help them to determine the nature and the performance of their investments in today's aspect and in future. So correct financial decision will determine the nature or how your investment is going to perform both in the present and in future. So we are looking at financial decision-making process. That is our second subtopic, financial decision-making process. Correct financial decision-making will have a positive impact on the nature or how your business is going to perform in future and in today's aspects. So your decisions should be very correct. And when we are told to discuss the financial decision-making process, the first stage in the financial decision-making process, we look at a situation where you identify your financial situation. You first identify your financial situation. Here you assess the various aspects of your financial life. You identify your financial situation. You review the nature of your today's financial status. What you need to adjust, what changes you need to make in your normal financial dealings. You identify your financial situation. You assess the nature of your financial decision, the various aspects of a financial decision, your financial needs, what you need to adjust on, what changes you need to make that will either improve the nature of your financial dealings, the changes that you need to make, what you need to retain, what you need to remove in your financial dealings. Once you've identified your financial situation, you'll go, our second stage or our second step, you will determine your financial goals. You determine your financial goals. Determining your financial goals. Here is where you're going to set your objectives. Yes, the purpose that you need to achieve in your financial situations. What you need to achieve. Here, an individual or a finance party is going to determine their financial objectives and their aspiration. And these goals can either be long-term or short-term goals. Determine your financial goals. These are your objectives. Or what you aspire to achieve, your aspirations. What do you aspire to attain? You are both, and the goals can be both long-term and short-term in nature. So you determine what you have to achieve at the end of a specific time frame. What you are supposed to have achieved maybe in 1 or 2 years' time. That is your financial goal. Once you've determined your financial goal, we look at our next stage that deals with identifying. You identify alternatives for investments. Alternatives for investments. That is our next stage in the financial decision-making process. Here, the finance planning, financial planning selects its alternatives, yes? You evaluate you select or you identify, you plan for your alternatives and present them in order to determine which one will suit your financial decisions. First of all, you're going to highlight various alternatives that match with your financial decisions, what you want to achieve in your financial decisions. You'll select the various alternatives that will help you attain your financial decisions. You identify the alternatives for investments. You choose other aspects or other alternatives and present them in order to determine which one will suit your investment or your financial decisions the best. Once you've identified your alternatives, you'll evaluate. That is our fourth step. You'll evaluate these alternatives. You evaluate the alternatives. Here, the finance manager, the finance planner will assess and identify, yes, you assess and identify the alternatives that suits your current situation, your financial standards, and personal interests. Evaluate. Once you've identified the various alternatives, you'll have to assess you'll have to assess the alternative that matches your current financial situations, or what are your personal interests. Which alternative will align with your personal interests? Here is where you evaluate. You've identified the various alternatives, and from the alternatives identified, you are going to do an evaluation. You review the alternatives and understand which alternative matches your current financial situation, which one suits your current financial position. Evaluate the alternatives. Once you've evaluated the alternatives, you'll implement. Yes, you implement. So you'll have to identify your financial situation. After identifying your financial situation, you determine your financial goals, your objectives. Once you've highlighted the objectives, what you aspire to achieve, you identify your alternatives for investments. After identifying the alternatives, you evaluate the alternatives identified for you to be able to select one alternative that will help you achieve the objectives that you identified. Evaluate the alternatives. After evaluation, you implement this alternative. Implementation means this is the action plan. The action plan. Putting into action the alternative that was selected. Here you are told that it's the action plan, yes, of the selected ways of achieving your short-term, immediate, or the long-term goals. Here you determined your goals. And once you determined your goals, you evaluated your alternatives. And you selected an alternative that matches your goals. Now, once you've selected it, you're going to implement it. You put it into action for you to be able to achieve in a manner that will help you achieve the objectives that you had priorly set. Implementation. Once you've implemented, the final stage is the monitoring. Here you monitor, control. Monitoring and control, here you track. This is the tracking process. Yes, you had set your goals here at your second stage. Then you implemented the alternatives that you selected. Well, after implementing these alternatives, you need to monitor. Yes, you monitor, it's monitoring and control. You have to monitor if the alternatives that you selected here, the one that you selected, the one you thought to be viable for you to achieve your objective, you evaluate whether these alternatives are in line with the objectives that you had set. This is the tracking process. Tracking process. Tracking in that you're going to compare the actual goals that you're achieving after implementing your strategy, or your alternative, to be precise here, the actual goal that you're achieving from implementing this strategy, and compare it to the goals that you set before you selected the alternative, and ensure, and this will help you understand whether the goals are in line, and if not, which improvements that are you supposed to take as an individual for you to be able to achieve the goals that you had set. The monitoring and control, the tracking process that helps you measure. Here you measure or you compare the actual progress that you have, or the actual objectives that you're achieving compared to the goals or the objectives that you had set before you selected your alternatives. So when told to discuss the financial decision-making process, we've said that the first one, you'll have to identify your financial situation. You determine your financial goals, identify alternatives for investment. You evaluate the alternatives, you implement the alternatives you've evaluated and selected. Then we have the monitoring and control stage, which is the tracking process. You track the progress of your financial decision, whether you're achieving the financial decisions that you had made, or what improvements you need to do for you to be able to achieve the financial decisions that you had made. Are we clear? Any question on the financial decision-making process? Yes, we're clear. Now let's look at the relationship between finance and accounting. We've already looked at the financial decision-making process. Now let's look at the relationship between finance and accounting. 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 How does these two relate? How does finance and accounting relate? First of all, but when you're told to discuss what finance is and what accounting is, that is one aspect that will give the relationship that exists between them. What you're supposed to know, accounting is a branch of finance, while finance is an aspect of economics. So the relationship that exists between finance and accounting is that accounting is a branch or is an aspect of finance, while finance, on the other hand, is an aspect of economic. So here on relationship between finance and accounting, a question can ask you to give the differences between finance and accounting. The differences between finance and accounting. Now let's look at the differences. The differences between finance and accounting. Our first difference, okay, let's look at accounting and finance on the other side. The differences that exist between finance and accounting. Accounting, in accounting, you're going to account for a past event, right? While finance, you are going to plan for your financial resources for you to achieve certain goals. In that aspect, you can say that accounting as an aspect focuses on the past. Accounting, you're going to account for the finances that you allocated on various activities. You account. Did the finance allocated to a certain activity achieve what it was meant to achieve? Meaning that you're looking for an event, that you are evaluating an event that already happened. So accounting as an aspect focuses on the past. Finance, on the other side, will focus on the future. It focuses on the future. So that is the first difference on the first difference between accounts and finance. Account as an aspect focuses on the past, while finance on the other side will focus on the future. Another difference between finance and accounting, you can say, account helps you, accounts as an unit or as an aspect, yes, or as a disciplinary, will help you prepare financial decisions. Accountants prepare the financial decisions, such as the balance sheets, yeah, the profit and loss accounts of an organization. So here, it helps you prepare, yes, financial statements. While finance on the other side analyzes this financial statement. So account will prepare the financial statements, while finance will analyze the financial statements prepared in the accounts disciplinary. So this one analyzes the financial statements. Another difference between them, as we said, accounts is a part of finance. So this is a part of finance. While finance, it's a part of economics. Part of economics. So we've already evaluated three differences, key differences between finance and accounting. We can also say that accounting is a method of recording. It's a method of keeping track of transactions of a business. Accounts, this one keeps track of business transactions. Accounts keeps the records, or it's a way of recording and tracking the business transactions, while finance managers use these records kept in the accounts record to analyze the financial decisions of the organization. So accounts will keep track of, it will keep the records that track the business transactions, while finance will use the records from the accounts department to make financial decisions. This one uses the records to make financial decisions. So these are the four key differences between accounts and finance. We have, and the first one is that accounts focuses on the past, while finance focuses on the future. We can also say that accounts as a disciplinary prepares financial statements, while finance will analyze the financial statements from the accounts office. Accounts as a unit, as a disciplinary will focus, is a part of finance, while finance is a part of economic. You can also say that accounts keep the records that track business transactions, while the finance uses the records from the accounts office for them to be able to make financial decisions that will be beneficial to the organization. So these are the key differences between finance and accounting. Relationship between finance and accounting. So that's what we have on relationship between finance and accounting. Now we have to look at the goals of a firm. Goals of a firm. Goals of a firm. Let's look at goals of a firm. On goals of a firm, we can say that an organization or a firm has two main goals, two main objectives. The first objective of a firm, we have the financial objective, or the financial goal, objective or goal, and the non-financial goal. So goals of a firm, when you're told to discuss the goals of a firm, they are telling you to discuss the financial goals of a firm, what a firm aims at achieving. It has the financial goal to increase its finances, to improve the finances, and the non-financial goals that might include the welfare of the employees in the organization, how to handle the customers within the organization, how to involve or to engage themselves in the corporate social responsibilities. So those are the sum of the non-financial goals of the firm. Now let's focus on let's first look at the financial goals. Financial goals of a firm. First of all, when you're told to discuss the goals of the firm, if they do not specify whether it's financial or non-financial goals, you're going to discuss both. We are going to give a brief discussion on the financial goals and the non-financial goals. But when told to discuss the financial goals of the firm, we are going to focus on two main aspects. We have the profit maximization. Profit maximization. This is the first financial goal of a firm. And we also have the shareholder wealth maximization. We have the shareholder wealth maximization. Profit maximization. Now let's look at profit maximization. Here, when told to evaluate profit maximization as a financial goal of the firm, here you're going to say that it's a situation where the finance manager aims at receiving the highest possible profit from their finances. Profit maximization. The finance managers, they aim at receiving the highest possible profit. Aim at receiving. So profit maximization is a process where the finance managers aim at receiving the highest possible profit of the firm. Yes. So the finance manager has an aim of receiving highest possible profits of the firm. Yes. And you can be asked, like, how can these finance managers be able to receive high profits? For them to receive high profits, what should finance managers do? Yes. So you can say profit maximization is a process where the finance managers aim at receiving highest possible profit, and this high possible profits can be achieved maybe by, for you to receive high profits, you can reduce on the manufacturing cost. So you can reduce, yes, your manufacturing costs. If the cost of producing an item is low, that means that and you sell it at a high price, that will help you as an organization acquire high profits. So you can acquire high profits by first reducing maybe the manufacturing cost of the product. You can also achieve these high profits by, you increase your selling price. You increase your selling price. So you can be asked on the various ways where finance managers can acquire or receive high profits under the profit maximization goal, financial goal of a firm. You can say the first one, they can reduce on their manufacturing costs, and also increase their selling price. So these are the two main ways through which the finance managers can be able to receive high profits for their organization. First, they reduce the manufacturing cost and also increase their selling price. So when told to discuss profit maximization, you'll say it's a process of receiving. It's a process where the finance manager receive high profits or aim at receiving the highest possible profit by reducing the manufacturing cost and increasing the selling price. So these high profits can be achieved through reducing manufacturing cost and increasing the selling price. Profit maximization has some limitations. Between these two, you can be asked, why do shareholders or finance managers, why do finance managers opt for shareholders' wealth maximization as the financial goal of their firm and avoid profit maximization as an objective of their firm? That question simply tells you to discuss the limitations. For them to avoid the profit maximization, meaning profit maximization as a financial goal has some limitations, the challenges. So let's look at the limitations of profit maximization. Limitations, or we can also call them the weaknesses. Weaknesses of profit maximization. The first one, the first weakness of profit maximization, we can say it's vague, yeah? Profit maximization is vague. To be vague, there are different types. To be vague means that there are various different types of profits that an organization can achieve. There is a profit after tax, maybe. There is a profit before tax. Yeah, maybe profit before tax and deductions. So this profit maximization, it does not specify what kind of profit this is. That's why it's called, it's a vague financial goal, because it does not specify on the nature of the profit, whether it's a profit before tax or profit after tax. It does not specify. And that's why we have this as a limitation. Profit maximization is vague, as it does not specify the nature of the profit, whether the profit is after tax or before tax. Another aspect or another limitation of profit maximization, it ignores risks. Ignores risks. Profit maximization as a goal of the firm does not consider the uncertainties that an organization faces to achieve the profits. All the challenges, the risks that the organization is going to involve itself into to achieve the profits are not accounted for. So it ignores risk. It does not account for the risk associated within the firm. The other goal, the other limitation or weakness, you can say it does not consider time value of money. Doesn't consider time value of money. Time value of money. As we priorly said, money loses value over time. The value of a shilling today might not be the same as the value of the same shilling tomorrow. But profit maximization as a goal does not consider this time value of money. It does not consider whether this currency or whether purchasing a good today, yes, will be different from purchasing the same good with the same price tomorrow. Does not consider time value of money. So when told to discuss the limitation, you can look at it's vague, it ignores risk, doesn't consider time value of money. We can also say there is selfishness and inadequacy. Selfishness. Or you can say it's a selfish and inadequate aspect of achieving financial goal. It's a selfish and inadequate. Here we can see that profit maximization will only consider the shareholders' interests. It's selfish in that it only considers the shareholders' interests. Yes, but it doesn't evaluate that there are other aspects that contribute to them acquiring these high profits. It only considers the shareholders. It only considers the shareholders' interests, but it ignores other stakeholders. An organization has the shareholders and the stakeholders. Stakeholders are aspects like the employees of the firm. You can talk of the customers, the auditors, or even the government. So it's selfish in that it only considers the shareholders, but it ignores the stakeholders who contributed to its achievement of the high profits. So it's a selfish and inadequate financial goal as it ignores the stakeholder interest. It only focuses on the shareholders' interests. Now that's why we say it's a selfish and inadequate goal. So that's what we have on profit maximization. We've evaluated what profit maximization is, how the organization can be able to, what organizations should do in order for them to achieve the high profits, where we said it's reduce manufacturing costs or even increase their selling price. And finally, we've evaluated the weaknesses or the limitations of this profit maximization, where we've said it's vague, ignores risk, doesn't consider time value of money, then it's a selfish and inadequate type of a financial goal. Now let's look at shareholders' wealth maximization. So we've already looked at the first financial goal, which is the profit maximization. Now let's proceed to shareholders' wealth maximization. Any question? Any question? There's no question. We can proceed. Now let's look at shareholders' wealth. Shareholders' wealth maximization. Shareholders' wealth maximization. This is our second financial goal of the firm. Here we can say it involves a situation where the firm aims at achieving maximum shareholders' wealth by obtaining net present value. Here, a firm, you can say that a firm maximizes the shareholders' wealth, right? And for a firm to maximize, a firm maximizing the shareholders' wealth, yes, by obtaining the NPV, the net present value. So here, it's a process where a firm maximizes the shareholders' wealth by obtaining the net present value. And for them to obtain the net present value, they'll obtain the net present value only through discounting the cash flows. So it's a process where a firm maximizes the shareholders' wealth by obtaining the net present value, which is obtained through discounting the cash flows of the firm. So it's a process where a firm maximizes the shareholders' wealth by obtaining the NPV through discounting their cash flows. That is the shareholders' wealth maximization. So you might be asked, like, why do finance parties opt for shareholders' wealth maximization as the financial goal of the firm and ignores the profit maximization goal of the same firm? When you're told to answer such a question, they simply want you to discuss the limitations, because shareholders' wealth maximization has this one has weaknesses. Yes, profit maximization discusses the weaknesses of the firm. Yeah. While shareholders' wealth maximization, on the other side, has favorable arguments. Favorable arguments. And the favorable arguments are the strengths that are the weaknesses of profit maximization. So the weaknesses or the limitations of profit maximization are the strengths or the favoring arguments, the strengths, yes, of shareholders' wealth maximization. So when you are told, why do shareholders choose why do finance members choose shareholders' wealth maximization as an aspect? They're simply telling you to discuss the favorable arguments of shareholders' wealth. And these favorable arguments are generated from the limitation or the weaknesses of profit maximization. Well, you're first going to say, the first favorable argument, we are going to say that it considers risk. Considers risk. Yes. The second aspect you can talk of considers time value of money. Time value of money. We can also talk of the fact that it's not a selfish, it's adequate as it considers both the shareholder and the stakeholders' well-being. It satisfies the interest of, so it satisfies both shareholders and stakeholders' interests. So that's what we have on shareholders' wealth maximization as the second financial goal of a firm. Any question up to that? Any question? Yeah, there's no question. Now we can proceed on the non-financial goals of the firm. So we've already looked at the financial goals of the firm. Now let's look at non-financial. Financial goals of a firm, they have the aim of achieving a financial aspect. There's a financial gain that the firm aims at. But for non-financial goals, there is no financial interest that the firm aims at achieving. The firm does not have any financial interest that it aims at achieving. Instead, these firms aim at achieving maybe favorable, yes? Sorry, we can talk of favorable welfare of the employee, favorable welfare of employees. That is the first non-financial goal of a firm. The firms aim at achieving the welfare, the needs, satisfying the needs of their employees, satisfying the welfare of their customers. Yes, we can also talk of the aim at achieving corporate social responsibility. Yes, this is where they achieve the needs of the society. Yes, engaging the society in order to achieve its goals, achieving the interest of the society. We can also look at promoting business ethics. This one can be looked at the welfare of the, it's another aspect. Let's say promoting business ethics. So when you're told to discuss the non-financial goals of the firm, you can talk of achieving welfare of employees, achieving the welfare of its customers, Achieving corporate social responsibility. Yes. That is the society. Then promoting business ethic. And the main non-financial goal of the firm is the growth. It's growth. So growth of the firm is another non-financial goal that the firm aims at achieving. It aims at growing. Yes, just like an individual aims at improving the nature of their standards of living. That is one nature or one non-financial goal of the firm. And this is the main non-financial goal of the firm, growth of the firm. And the firm grows when there is welfare of its employees, there is welfare to the customers. This one will help them in retaining their customers, achieving the corporate social responsibility, the society, promoting business ethics, such as maybe business ethics, maybe following the government regulations, yes, promoting secrecy or confidentiality in business operations, promoting business ethics. So this is what we have on nature. Oh, sorry, on non-financial goals of the firm. Any question? There's no question. So I guess there are some subtopics that I'm going to leave you to go through them, because I want us to complete our first chapter. You'll look at the functions of financial markets. Look at the functions of financial markets. Sorry, functions of financial management. At your own time, also look at the roles of finance managers. So you look at the functions of financial management. You also look at roles of finance managers, because I want us to proceed to agency theory. Agency theory. I want us to start on chapter 5 that deals with valuation of assets. Valuation of assets. During our next class. And that's why I want us to complete on chapter 1. Let's briefly look at agency theory. Agency theory is a relationship, yes? Agency theory, relationship. The relationship between an agent and the principal. Relationship between an agent and the principal. This is the owner. Agency theory. Here you look at the relationship between an agent and the principal. And that's why it's called the principal-agent relationship. Agency theory can also be termed as the principal-agent relationship. Agency theory. So there are various theories. There are various relationships that exist under the principal-agent relationship theory. There are various relationships. And we have the first relationship to be a relationship between a shareholder and the management. We can look at the relationship between a shareholder and the management. A relationship between the relationship between shareholder and the creditors. Yes, we can also look at the relationship between shareholder and the government. Shareholder and government. We can also look at the relationship between shareholders and auditors. And also a relationship between head office and branch. Head office head office and branch. So when you're told to discuss the various principal-agent relationship under agency theory, you'll discuss the relationship between a shareholder and the management, the shareholder and the creditors, shareholder and the government, shareholder and auditors, and also you have the relationship between the head office and branch. Here, there is one member who is the agent and the other one who is the principal. The agent benefits themselves, yes, from the agents, they benefit from the hard work or they achieve their interests at the expense of the principal. Agents fulfill or achieve their interest at the expense of their principal. So for instance, like the shareholder and management relationship, we can say that the shareholder is the principal. In this case, the shareholder is the principal, yes, while the management will be the agent. So when you're told to discuss maybe a relationship between shareholder and management, you'll first have to identify, who is your principal and who is your agent. So like for shareholder and management, as you'll know, shareholder is the principal, management is the agent. The management will perform some duties that benefit themselves, but maybe at the same time, they affect the shareholders. And that's why we call the shareholders as the principal, while the management as the agent. We have a relationship between shareholder and the creditors. Creditors offer maybe loans, yes, for instance, or they lend money to the shareholders of certain firms. So the creditors are the ones who take the who issue or who perform an action to an individual. So the shareholders here will be the agent. They are the ones receiving actions of the creditors, who are the principal. So the relationship between shareholders and the creditors will be the principal, because they're the ones giving out loans to the shareholders. Yes. You also have shareholders and government. The shareholders will be the agent, while the government is the principal. Shareholders and auditors, these ones are the agents. Shareholders are the principal. Yes. The head office and branch, these ones are the agents, while the head office is the principal. So first, when you're told, for example, to discuss the challenges or the conflicts that may arise between a shareholder and the management, because here, under agency principle, a question might come asking you to discuss the various conflicts that tells you to discuss the various conflicts. Sorry, the various conflicts that may arise between maybe a shareholder, between a shareholder and management. You'll first identify who is the principal and who is the agent, then discuss the various conflicts that may arise and how you're going to solve these various conflicts. You might be asked that shareholders are basically the owners of the firm, yes? But why are they not allowed or given the rights to manage these firms? Shareholders are the owners of the firm, but they are not given the chance to manage these firms. And you're told to evaluate the reasons. Here you're going to say, for instance, a firm might have 3 or 4 managers, the 3 or 4 shareholders who own the firm, yes? But all the 3 members cannot manage a single firm. There might even be 10 shareholders in a firm. All of them can't be given the authority to manage the firm. So when you're told to discuss the reasons why shareholders are not given the right to manage a firm, you can say that the first reason is that they may be too many to manage a single firm. There may be too many to manage a single firm. The second one, we can say that these managers, they might be geographically dispersed. They might be located in different geographical areas. And thus maybe a farm is in Nairobi, yes, and we have some shareholders who reside from Mombasa or those from Kisumu, for instance. All of them can't, and the farm is in Nairobi. They can't all be in Nairobi to manage this farm. So maybe they're geographically dispersed. Yes. Another one is to avoid conflict of interest. Conflict of interest. This is the main reason why shareholders are not allowed to manage their farms, to avoid conflict of interest. And for this not to happen, the farm will be forced to seek a party that is not a shareholder for it to manage the farm, because conflicts of interest, a shareholder might, when you choose one shareholder to manage the farm, the member might have the interest of sustaining their own needs, achieving their own interests, and that will affect the performance of the farm. And that's why you'll be forced to seek a member that is not one of the shareholders to manage the farm. So one of the main reasons why shareholders are not allowed to manage their farm is that it will help them avoid the conflict of interest that may arise between them. We can also look at, we might also say that these managers, yes, might lack the necessary skills. So lack of skills. So the managers might lack the necessary skills that they need they may lack the necessary skills needed to run or manage a specific farm. Lack of skills to manage a specific farm. So when you're told to discuss why shareholders are not given the right to manage their own farm, is that the first one, maybe they may be too many. That is the first reason, too many to manage a single farm. They may be geographically dispersed. It may be used, they may be avoided to reduce the conflict of interest that may arise between them. And you can also say they may lack the necessary skills that are required to manage this farm. So these are the four main. We can also say that maybe these investors may be occupied with some other duties. They have some other activities that need their attention. And thus managing the farm and attending to their daily activity might be hard. So they may be having other duties. They may have other duties that need their attention, and thus managing the farm and attending to their duties might be hard. This is a common question. This is an examinable question. When you are told to discuss why shareholders, you are told that shareholders are the owners of the farm, but they are not, or they may not be given the right to manage these farms, and told to highlight the reasons. First, said there are too many. They may be geographically dispersed. To avoid conflict of interest, they may lack the necessary skills, and also they may have other duties that need their attention, and thus managing the farm and attending to their day-to-day duties may be hard. So there are various conflicts that may arise between the 5 relationships that we've spoken about, and I guess you can look at this at your free time. I guess that is right with you. You can look at the conflicts that may arise, the conflict that may arise from the various relationship under the agent-principal relationship of agency theory. You'll have to look at this. Okay? So you can look at the conflicts. Is that okay? At your free time, look at the conflicts. So I've given you 3 tasks. The first one, you look at the functions of financial management. You'll also look at the role of finance managers, and also look at the various conflicts that may arise under the agency theory, under the relationship between the principal-agent relationship. You can look at the various conflicts that may arise. I guess this is what we have on our first chapter, which is the nature and scope of finance. Nature and scope of finance. I guess that is okay. Any question on nature on our first chapter? Nature and scope of finance. Nature and scope of finance. Any question? If there's no question, I guess we are clear up there. And so I'm going to end my session there. When we meet next, I'm not going to proceed to the second chapter. Instead, we are going to go to chapter 5 that looks at evaluation of assets. I told you we are going to focus mostly on the calculation part of introduction to finance and investment, because our papers covers most of calculation than theory. Yeah, you might be asked a question or two on theory, but the most question cover the calculation part. And that's why I've said from next class, let's begin from valuation of assets. This is the calculation part. Yes, as calculation have higher marks and you can't miss them all. So we will start on valuation of assets. That is on our Tuesday's class. We will look at valuation of assets. Is that okay? So you have another class scheduled for this time. And the request, okay, it's fine. We'll look into that, then we will adjust the timetable, okay? We will look into that and adjust the timetable. It's fine. Thank you. And I hope you enjoyed the session. Let's meet during the next class. Okay, fine. Have a good day.